Have you ever just felt completely swamped by, all the financial news, the endless tips, the advice coming from everywhere, often contradicting itself?
Oh, absolutely. It's a constant flood.
It really is. It feels like trying to find, I don't know, a tiny bit of gold in this huge river of mud. How do you actually cut through that noise and find real wisdom, something that lasts? So today, we're going to dive deep into a book that many people call like the investor's Bible. It's Benjamin Graham's The Intelligent
A
Investor.
true classic.
It really is. And it's not just any guide. It's often seen as the foundational text. It fundamentally changed how a lot of really successful investors think about the market, including some very, very wealthy ones.
Right. And our mission here in this deep dive is really to pull out the absolute core, the timeless wisdom from this incredibly influential book. We want to equip you with the principles that don't just protect you from making big mistakes, but actually help you build long-term financial success, bypassing the fads to get to what really works.
And the source material we're using for this deep dive, just so you know, is a really thorough book review. It does a great job summarizing this classic guide, pulling out the most crucial insights on investing smartly, managing risk, and just general financial wisdom. Think of it like a significant shortcut to understanding a book that's dense but packed with important ideas.
Definitely a good starting point.
So let's set the scene a bit. The Intelligent Investor, it was first published way back in 1949.
Yeah, a long time ago.
Long time ago. But the principles feel astonishingly relevant, which is kind of amazing. And the author, Benjamin Graham, he's widely known as the father of value investing. And maybe even more famously, he was the guy who mentored Warren Buffett.
That's his big claim to fame for many people, yes. But what's really crucial to understand about Graham right from the start is that his whole focus wasn't on, speculating or chasing quick profits. Not at all. It was always about long-term, disciplined investing. And it had to be anchored in understanding the fundamentals of a business and, importantly, thinking rationally.
So this isn't about getting rich quick.
No, definitely not. It's about steadily building real, lasting wealth over time.
Okay. And this is where I think it gets really interesting. Graham doesn't just start talking about stocks. He kind of resets how we should even think about investing in the first place. What's that first big distinction he makes?
Well, he draws this incredibly sharp line between an investor and a speculator. For Graham, an investor is like a careful detective. They only buy something after doing thorough analysis, really digging in. Their main goals are, first, keeping their initial capital safe, and second, getting a satisfactory return over the long haul. They focus on the business itself.
Okay, the careful detective. I like that. And the speculator.
The speculator is, he's more like someone playing roulette. They take on high risks, often just chasing quick gains based on market swings or maybe some hype they heard.
Right.
And Graham is really clear on this. Unless you are fully prepared, truly understand all the risks involved, and crucially, you can actually afford to lose the money, you should stay away from speculation, period.
Okay, so principle number 1. Be an investor, not a speculator. But even careful investors make mistakes, right? Or the market does something totally unexpected. How does Graham account for that? Is there a safety net?
Yes. That brings us to maybe his most fundamental concept, the margin of safety.
Margin of safety.
It's basically your built-in protection, your cushion. It means you only buy stocks when their price is significantly below what your analysis tells you their actual intrinsic value is. Think of it like building a bridge. If you know it needs to hold 10 tons, you design it to hold, say, 20 tons. That extra capacity is your margin of safety. It protects you if your calculations were a bit off, or if conditions change unexpectedly.
Well, that makes a lot of sense. It's a buffer.
Precisely. It's your buffer against errors and just plain bad luck. It's key to protecting your capital.
And one of his most famous ideas, the one I always found so vivid, is Mr. Market. This idea of having this, emotional business partner who shows up every day offering to buy your shares or sell you his.
Yeah, it's brilliant.
It really is. I mean, I've definitely felt like I have my own internal Mr. Market sometimes, especially when things get volatile. How does that analogy actually help someone deal with the day-to-day market madness?
Because it perfectly captures the irrationality we all face. Mr. Market, this partner, is incredibly emotional. One day he's euphoric, offering crazy high prices because he thinks the future is limitless.
Right.
The next day, he's sunk in despair, terrified, and willing to sell you his shares for way less than they're worth just because he's panicking. Now, the average person feels that panic too and might sell low with him. But the intelligent investor, Graham says, learns to use Mr. Market's mood swings.
Ah, okay.
You take advantage of his pessimism to buy shares cheaply. And maybe you consider selling to him when he's overly optimistic and offering you a silly price. The absolute key is you never let his mood dictate your actions or your view of the value.
So you use his emotions, but don't adopt them.
Exactly. You remain rational while he's being irrational. That's the edge.
Got it. Graham also talks about two types of investors, the defensive and the enterprising. Can you break those down? How would someone know which camp they fall into?
Sure. So the defensive investor is basically someone who wants safety and freedom from bother, mostly. They prefer a more passive approach. They're looking for safe, steady, long-term returns, but with minimal effort. So they might focus on things like diversified index funds or maybe very stable, large blue-chip companies or high-quality bonds. Consistency and low effort are key.
Okay, the set it and forget it type maybe.
Sort of, yeah. Though still requiring some thought. Now, the enterprising investor, by contrast, is willing to put in the time and the intellectual effort. They're actively looking for value, maybe in stocks that are out of favor, overlooked, or even in temporary distress. They do much deeper research to find opportunities the general market might be missing. It really comes down to how much active work you're willing and able to do.
Right, so it depends on your time, your temperament, and your expertise, I suppose. So if we pull these threads together, margin of safety, ignoring Mr. Market, maybe being an enterprising investor, digging for value, what we're really describing here is value investing, isn't it?
Precisely. Value investing is the practical application of all these core ideas. It forces you to look deeply into a company's actual fundamentals. Things like its earnings history, its dividends, its financial strength, its management quality, its long-term prospects. And, critically, it means deliberately tuning out the short-term noise, the market fads, the hot trends, the constant media hype.
It's about substance over sizzle.
Beautifully put. Substance over sizzle. Enduring worth over temporary popularity.
Okay, so we've got these core concepts. What does this all mean for you listening right now? Because Graham's wisdom, it feels like it goes beyond just picking stocks. There seem to be some really timeless lessons here for anyone on a financial journey.
Oh, definitely. And they're powerful. First, and maybe foremost, discipline beats emotion. Making decisions based on fear when the market drops or greed when it's soaring. That almost always leads to poor results. You need a rational framework.
Easier said than done sometimes.
Oh, absolutely. Second, patience is power. Good investments often take time to work out. It's rarely an overnight success story. You need to let compounding work its magic. Third, ignore the crowd. Popular opinion, especially in finance, is very often wrong. Following the herd can lead you right off a cliff. Think independently.
Okay.
Fourth, know what you're buying. This sounds obvious, but it's crucial. Never invest in anything you don't actually understand. If you can't explain the business or the investment simply, you probably shouldn't own it.
That's a great rule of thumb.
And finally, and this trips people up, volatility is not the same as risk. Price swings, even big ones, aren't necessarily dangerous if you have that margin of safety. In fact, they can be opportunities, right? A chance to buy low from Mr. Market. It really raises an important question, though. How do you actually train yourself, rewire your brain, to see opportunity where almost everyone else just sees danger and panic?
That's the million-dollar question, isn't it? Having that framework, like you said.
It is. It's about having that intellectual discipline to manage the emotional side.
Now, okay, the book's from 1949. Some people might think, well, that's ancient history. Markets are different now. And that's where Jason Zweig comes in, right? He's a financial journalist who added commentary to later editions.
Yes, and Zweig's contribution is absolutely vital. He does a brilliant job of taking Graham's timeless ideas and illustrating them with modern, relevant examples. Think post-2000 market events.
So he bridges the gap.
He really does. He provides that contemporary context. And he also issues these really strong warnings against the new forms of speculation that pop up in every era. He specifically talks about things like the tech bubbles, the dot-com crash.
And I bet things like crypto hype fit right in there, too.
Exactly. He uses recent history, like the dot-com bust and the huge 2008 financial crisis, to show how Graham's core messages, margin of safety, investor versus speculator, Mr. Market held true, how they would have protected people. If you connect this to the bigger picture, it just makes it crystal clear. These principles aren't tied to a specific time or technology. They're about human behavior and business fundamentals, which don't change nearly as much as the headlines do.
That's a powerful point. So let's sum up the strengths of the book, or maybe the approach. We're talking deep financial wisdom, strategies that have stood the test of time. Those simple metaphors like Mr. Market really stick with you.
Mm,
And maybe most importantly, it pushes you towards critical thinking instead of just reacting emotionally.
absolutely. Those are the big pluses. Now, on the flip side, we should be fair about the drawbacks. The original text, Graham's writing style, it could be dense, a bit academic.
Yeah, it's not exactly a beach read.
No. It can be challenging, especially if you're a complete beginner. And yes, the original examples are dated, even though the principles aren't.
Yeah.
Zweig helps massively there, but you still feel the age sometimes. And let's be honest, it takes patience. You have to be willing to really sit with the ideas, absorb them, and then figure out how to apply them. It's not a quick fix.
Right. So who is this book really for? And who is this deep dive for?
Good question.
It sounds like it's for serious investors, people in it for the long haul, definitely not day traders or speculators.
Right.
Anyone who's really trying to build wealth over time, maybe students of finance or business.
Yes, definitely. Foundational reading.
And I guess anyone who wants to understand the thinking behind someone like Warren Buffett's success.
Exactly. If you want to understand Buffett, you have to understand Graham. This is the source code in many ways.
Okay. So, wrapping up, The Intelligent Investor. It's clearly not a get-rich-quick scheme.
Not even close.
It's not promising instant riches. It sounds much more like a manual for developing financial wisdom.
That's a perfect way to put it. A manual for wisdom. Its real purpose is to teach you how to think like an owner, like a true investor. How to tune out all that market noise, which is louder than ever today.
There's so much noise.
And how to focus resolutely on long-term fundamental value. These principles, if you apply them, can genuinely protect you from very costly mistakes. They can set you up for, well, for a lifetime of more successful financial decision-making. It's why the book gets such incredibly high praise, that 9.5 out of 10 rating we saw in the review, and why it's pretty much universally seen as a must-read for anyone serious about investing.
Okay, so here's a final thought to leave you with as you go about your day. Thinking about all this, how might really internalizing Graham's idea of the margin of safety, or learning to recognize when Mr. Market is being irrational, actually change your next financial decision, even a small one? What part of your own approach to money or investing could you maybe handle with a bit more discipline now, and crucially, a little less emotion? Something to think about.